Welcome back to Crypto Macro Insights. I'm Maya, and it's Tuesday, September 2nd, 2025. Tom, just 72 hours after our last conversation about the ultimate convergence, we're now literally 48 hours away from what might be the most defining moment of this entire macro cycle. The reverse repo collapse has accelerated even further. We're now at just $21 billion, down from nearly $120 billion 6 months ago. That's an 82% collapse, Tom. Are we witnessing the final capitulation phase before the great liquidity flood?
Maya, what we're seeing is absolutely unprecedented. That 21 billion figure represents the lowest level since the reverse repo facility's modern inception. We're talking about a liquidity injection that makes our previous 250 billion estimate look conservative. We're now approaching $300 billion released into the system in 6 months. But here's what's fascinating. Bitcoin is holding remarkably stable at $109,000, while retail psychology has somehow gotten even worse. I'm seeing genuine despair, people talking about being unemployed for months, complete rotation into gold mining stocks. The divergence between institutional positioning and retail sentiment has never been this extreme.
And this brings us to the critical 48-hour window. Thursday, September 4th, we get the ADP National Employment Report, followed by Friday, September 5th, with the Employment Situation Report, the official non-farm payrolls. Tom, you've been calling this the make-or-break moment for the entire thesis. With everything we've discussed, this unprecedented liquidity injection, the extreme retail institutional sentiment divergence, Bitcoin's resilience at these levels, how are you positioning for these employment reports?
Maya, I'm upgrading my conviction from 60% to 65% on the bull case. Here's the refined thesis. With 300 billion in liquidity now flooding the system and retail psychology this completely broken, the employment data doesn't need to be catastrophically weak anymore. Even marginally disappointing numbers could provide the Federal Reserve with perfect justification for aggressive accommodation. What's changed since our last conversation is the acceleration. The reverse repo collapse has sped up, retail capitulation has deepened, but Bitcoin is actually consolidating higher at 109,000 versus the 112,000 we discussed before. This suggests institutional positioning has intensified ahead of these reports. The key insight is that weak employment data now becomes the catalyst for the Fed to unleash even more accommodation into a system already flooded with liquidity.
So let's talk scenarios. If we get weak employment data on Thursday and Friday, what's your base case target for Bitcoin? And conversely, if the data comes in stronger than expected, which would go against this retail despair we're seeing, how do you think the market reacts? Walk us through your probability assignments for each scenario.
For the bull scenario, which I'm assigning 65% probability, weak employment data combined with this liquidity backdrop could send Bitcoin to $125,000 to $130,000 within 2 weeks. That represents the break of major technical resistance and the beginning of institutional FOMO as they realize the Fed pivot is confirmed. The base case, about 25% probability, is mixed data where we see continued consolidation between 108 to 115,000 as markets wait for more clarity. The bear case, only 10% probability now, would require significantly stronger than expected employment data, which would delay Fed accommodation and could test Bitcoin's $100,000 psychological support. But Maya, here's what's critical. Even in the bear scenario, this liquidity is still in the system. It's not going away. So any weakness becomes a buying opportunity for the bigger move later. Maximum 3 to 5% of portfolio, Maya. Even with 65% conviction, this is still a binary catalyst trade. Stop loss at $105,000. That's where the technical support breaks and would signal our thesis is wrong. Take profit targets. First at 125,000, then 135,000 if we get the full bull scenario. But here's the nuanced part. If we get weak employment data but Bitcoin doesn't immediately respond, don't panic. Sometimes it takes 24 to 48 hours for the full implications to be priced in. The key is discipline. If the employment data comes in strong and we stop out, we reassess. But remember, the liquidity is still there. The reverse repo collapse doesn't reverse overnight. So even a failed trade here doesn't invalidate the longer-term thesis. It just delays the timing. The most important thing is surviving to play the bigger game when the Fed does inevitably pivot. Maya, we are 48 hours away from potentially the most significant macro inflection point of this decade. $300 billion in liquidity has been injected through reverse repo collapse, money that has to flow somewhere. Retail psychology has reached levels of despair I've never witnessed, while institutions are positioned for explosive upside. The employment data doesn't need to be catastrophic. Even marginal weakness could trigger Fed accommodation into an already liquid system. Bitcoin holding 109,000 during maximum retail capitulation confirms smart money accumulation is accelerating. If the stars align, weak employment data and Bitcoin breaking 115,000, we could witness the beginning of the most significant wealth transfer in cryptocurrency history. But remember, extreme discipline is required. This is not a time for YOLO trades. It's a time for calculated positioning with strict risk management. The opportunity cost of not being positioned appropriately could be enormous, but the risk of being over-leveraged could be catastrophic. The convergence is here. The setup is unprecedented, but fortune favors the prepared mind.
Incredible analysis as always, Tom. To summarize for our listeners, we're 48 hours from potentially the most defining moment of this macro cycle. The reverse repo collapse to $21 billion represents nearly $300 billion of liquidity injection, the most aggressive monetary accommodation since COVID. Retail psychology has reached genuine despair while institutions remain positioned for explosive upside with the VIX compressed to 16.12. The yield curve steepening to 0.62% signals growth expectations, not recession fears. Bitcoin's consolidation at 109,000 despite maximum psychological pressure confirms institutional accumulation ahead of critical employment data. Thursday's ADP report and Friday's employment situation represent the binary catalyst that could trigger the most significant opportunity in crypto history. Remember the framework: maximum 3 to 5% position sizing, stop loss at 105,000, targets at 125,000 and beyond. The convergence of $300 billion in liquidity, extreme retail capitulation, and potential Fed accommodation creates a setup that occurs once per decade. Thursday and Friday will tell us everything. Until then, stay disciplined, stay positioned appropriately, and remember, in extreme markets, extreme preparation meets extreme opportunity. We'll be back tomorrow for final pre-employment positioning analysis. The 48-hour countdown begins now.